Welcome back to the class. In this class, we'll be talking about the trend line and the trend structure. Also, we'll talk about support and resistance zones. All this while, we've been talking about the basic concepts of trading, the basic concepts of forex trading. Now we're heading into more serious things, more serious aspects of trading, and this class promises to be very interesting. So I will urge you to pay attention as we move into the class. Objectives of the class. Now in this class, I expect that by the end of the class, you should understand what a trend structure is, the three types of structures, what is a trend line, what is support and resistance. What is trend structure? A trend structure is a description of how the price of a trading instrument or pair has moved over time. Now, when price moves, it doesn't just move in a linear pattern. It doesn't just move straight up or straight down. Price creates a wave-like pattern. It goes up, it comes down, it goes up, it comes down. Now, the wave-like pattern that the price creates as it goes, whether it's heading up or it's heading down, that is what we refer to as the trend structure. We need to understand that price never moves in a linear manner. Rather, it falls and rises over time. In the midst of the up and the down movement, a pattern can be identified. This pattern is what we refer to as trend structure. There are three types of structures. So we'll look at the three types of structures and explain them in the next slide. We have the upward trend, or we call it the bullish momentum. The upward trend is when price is trading from when a pair is trading from a lower price to a higher price over time. It could go up and go down, but if you look at the overall movement, you find out that price have been appreciating over time. The price of a pair has been appreciating over time. Now we also have the downward trend, also known as the bearish momentum. This is when price depreciates over time. There's a decline in the price of a commodity. There's a decline in the price of a pair. So you see the chart go in the downward direction. Now there are times when price will neither go up or come down. If you look at it over time, you find out that price just moves in a sideways direction. That means you have price just moving, maintaining a particular range. It could move from one price to another and come back to the previous price and goes back. I'm going to show you examples of this on the chart as we proceed. This is also known as the ranging market. The upward trend or the bullish momentum. An upward trend is a trend structure in which price makes higher swing lows and higher swing highs. I remember in the introductory class or in the introductory courses, I introduced the swing lows and the swing highs to you. I told you that the swing points are points on the chart, on the price chart, where price turn. They are the turning points. Now, if you look at the chart and you find out that the successive swing highs and the swing lows are progressive in manner, that is, they are higher than the previous, you will spot an upward trend. Now let's look at what I just explained. If you look at this chart, you find out that we have a swing low here, and it came up and made a swing high here. they made a second swing low which is higher than the first swing low. You also see another swing low here that is higher than the second swing low. Once you can spot this pattern on a chart, just know that you are in an upward trend. And there is a saying that the trend is your friend. Your ability to spot a trend is very, very important as a trader, because once you are able to spot a trend early or know when a trend is about to change, you will have the advantage of riding that trend all the way up. Imagine entering a trade somewhere here and riding it all the way to the upside. That's a lot of money for you. We're going to be discussing all that in the subsequent classes. Now let's go to the next slide. The upward trend or the bullish trend. Now the upward trend, apart from having the upward trend, apart from making the higher highs or the higher lows, there's something we need to understand about a wave structure generally. The price does not just go in a linear manner. It doesn't just go up. It goes up, it comes down, creates a swing, then it goes up again. Now, the direction or the wave in the direction of the general flow is called the impulse move or the impulse wave, while the one that is counter the general move, you can see that the general move is upwards, but there are some movement in the downward direction. This downward direction is called the corrective move or the corrective wave. Downward trend or the bearish momentum. A downward trend is a trend structure in which price makes lower swing highs and lower swing lows, which we call the lower highs and the lower lows. So looking at this chart, you will find out that price is descending. The price of this pair is descending over time. But in as much as it's descending, you find out that it didn't just go down all the way like this. It went down, came up, created a swing, came down again, created a swing. Now you find out that the swing highs are reducing over time. The successive swing high is lower than the previous. That means the second swing high is lower than the first swing high. Look at the swing lows also. The second swing low is lower than the swing low, the first swing low. So once you have this kind of pattern, you know that you are in a bearish momentum or a downward trend. In the subsequent modules, I will be showing you how to identify this trend and how to take advantage of this trend. Sideways trend or the ranging market. A ranging market is a structure where the market makes equal swing low and equal swing highs over time. That's what we call the equal lows and the equal highs. Now looking at this chart, you find out that the swings are more of equal to each other. In as much as we have some spikes, yes, this is a typical price action, maybe typical manipulation. We'll talk about that later on. But if you look at it on the average, you find out that the swing highs are almost lined up on a horizontal line. You find out that the swing lows also are almost equal. So once you have this kind of structure, you know that you are in a ranging market. A ranging market can be very profitable if you know how to trade it. We will be talking about all this in the implementation part of this course. What is a trend line? A trend line is a diagonal line that joins the swings of a trend. That is an upward trend or a downward trend. It is used to denote areas of importance on the chart. Now, when you have an upward trend or a downward trend, in order to mark out this trend successfully, or mark out this trend so that you can identify possible pullback areas or possible areas where the price will come back to form a swing, you use a trend line to join the successive swings. I'm going to show you that in the next slide. It is popular belief that once price breaks a trend line, it is an indication that trend is about to change. We'll discuss trend and momentum change in details later in the course. Now let's look at the trend line. You find out that we have a trend, an upward trend here. This trend line joins the swing lows. You find out that it joins this swing low. This is the first swing low. This is the second swing low. Now, the importance of this trend line is that once you have been able to point out the first and the second swing low, you can actually predict where the next price is going to come to before it starts heading back into the impulse direction. That's when the corrective wave comes. You can identify the next point before the next impulse wave starts. So what we look at from here is we draw the trend lines to touch the tip of the wicks. To draw a trend line, you must connect the tip of the wicks. Now, also I mentioned in this course that by the time a trend line is broken, it's an indication that price wants to turn. If we were in an upward trend, we'll be looking at going down to changing over to a downward trend. Now, just as we have here, there was a break of the trend line, and see what happened. Price collapsed all the way down. Now look at this trend line, downward trend line that is connecting the swings of the downward trend. Now, if you had connected this and this, you can predict that price could come back to this point of the trend line and collapse all the way down. Now, with this, you can anticipate an entry around here and make your profit all the way to the downside. Let's go to the next slide. What is support and resistance? Support and resistance are horizontal lines or zones used to join several swings in a ranging market. Just like we use a trend line to join swings on a trending market, we use support and resistance to connect swings of a ranging market. So support joins the swing lows, while the resistance joins the swing high. Let me show you what I'm talking about. Now you can find out that the swing highs are joined by the resistance. So this upper limit is called the resistance zone, or it's called the resistance line. Now the lower limit that joins the swing lows is called the support. All these things we'll be talking about in the implementation part, in the execution part of this course. This is just to introduce you to the concept of trend lines, trend structure, and support and resistance. Things to note about trend lines, support, and resistance. They are used to determine possible turning points in the market. Just like I explained in the early part of this course, I said the basic work of a technical trader is to sit on the chart and anticipate possible turning points on the price chart. Now, the support and the resistance and the trend lines help you to spot possible turning points on the trend line. We'll look at how this is implemented and how this is done in the subsequent classes. They clearly mark out the phase of the market, whether it is in a bullish or bearish or ranging phase. Now, the support and resistance and the trend line tells you whether a market is ranging, whether it is bullish or is bearish. They are used to mark out price of interest or points of interest on the chart. Now, what we mean by points of interest is still turning points on the market, possible points on the market where on the price chart where you can make your entries, notable points that will give rise to a trend change or a trend continuation. Thank you. I will see you in the next class. Thank you very much for attending today.